We pick it on our first illustration on trade association, amateur sporting, and clubs. So our first question is November 2016. That is question 2B. We read the question. The following information was extracted from the books of Michezo Sporting Club for the year ended 31st December 2015. The club manager did not submit income tax return as he argued the club was exempted from taxation. He has consulted you for professional advice. He has consulted you for professional advice. So additional information, we're being told that the club received from gross income during the year ended 31st December 2015, amount of 35 million, which was analyzed as follows. So the first item on 35 million was entrance fee, a figure of 4,770,000. We have the next, that is members' contribution, 15,900,000. We have interest on late subscription, that is 795,000. Then we have interest income, that is fixed deposit, 2,544,000. We have dividend income, a figure of 1,272,000. We have royalty, a figure of 1,908,000. Then we have the rent income, a figure of 6,360,000. Then finally, we have what we call gain on property transfer, a figure of 1,141,000. Then you're being told on additional information too, operating expense amounted to 6,360,000. That interest and dividends income was stated gross of tax. So number one, advise the club manager on circumstances under which members clubs are taxed in your country. So we understand that for the members club to be taxed, number one, we have two investment income. When it's making taxable investment income, that should be taxed. Then again, on the item of members contribution, we basically say that on members contribution, if members contribution constitutes 75% of the total taxable income, then those members contribution should not be taxed. However, even in that scenario, taxable investment income should be subjected to tax. So B, assume whether Michezo Club is subjected to taxation for the year ended, whether Michezo Sporting Club is subjected to taxation for the year ended 31st December 2015, and applicable tax liability. So we get back to the initial analysis. So initial analysis, we read on additional income. Entrance fee is part of members' contribution, part of members' gross contribution. So percentage, we first of all get the percentage of what you call percentage of gross members contribution. So percentage of gross members contribution, that should be the gross members contribution over total, what you call the total taxable income times what you call 100%. Again, we explain. When you talk about total taxable income, that is the gross members contribution plus the taxable investment income. So on additional information, we get the contribution and the investment income. So number one, we have the entrance fee, that is part of members contribution. So we can get gross members contribution, gross members contribution, that should be, part of it is entrance, 4 million. We have a figure of 770,000. Then we have the next, what we call members subscription. That is part of members contribution. That should be 15,900,000. That should be 15,900,000. Then interest on late subscription. That is part of members contribution. So this is 795. However, we read the whole item. Next is what we call interest income on fixed deposit. That is an investment, but taxable investment income. Dividend income is also a taxable investment income. Royalty is also taxable investment income. Then we have rental. That's also taxable investment income. However, gains on property transfer, those are non-taxable income, because for the withholding, we know that before January 2023, the rate was 5%. The CGT, the capital gain tax, should be final tax. So that is not a taxable investment income. So we get the gross members contribution, we add that, and we get the gross members contribution. So the gross members contribution should be what we have as 4,770,000 plus 15,900,000 plus 795. So that should give us a figure of 21,465,000. A figure of 21 million. A figure of 21,465,000. Then we get total taxable income. So total taxable income, we have the gross members contribution, which is 21,465,000. We add to the taxable investment income. The first taxable investment income is the interest income. So we have it plus interest income. That should be 2 million. We have it as a figure of 2,544,000. 2,544,000. We have the next, which is a dividend plus, we have the dividend income. So dividend income is 1,272,000. Then plus what we call royalty. So royalty is a figure of 1,908,000. Then we have the rent. So we have the rent plus the rent, which is a taxable 6,360,000. However, for the capital gain on property, that is not taxable because the CGT is basically final. So we get that figure. We have 21,465,000 plus 2,544,000 plus 1,272,000 plus 1,908,000. Then we have plus 6,360,000 plus 6,360,000. So we have that as total taxable income as a figure of 33,549,000. So we are here to check whether those members' contributions should be subjected to tax. So that should be 465,000. You divide by, that is 33,549,000 times 100%. So that figure we multiply by 100%. So we have 21,465,000 divide by 33,549,000, then times 100%. So when you multiply that, that should be about 63.98. If you round it off, that should be 64%. If I look at this figure of 64%, those members' contribution do not constitute above 75%. And so therefore the members' contribution should be subjected to tax. So we go to part 2. Now the tax that they need to pay. Assess whether Michezo Sporting Company is subjected to taxation. Yes, it is subjected to taxation based on this information, because number one, whether this was above 75% and above, still on the taxable investment would have subjected to taxation. However, the members' contribution would have not been subjected to taxation. So Michezo Sporting Club, so we say taxable income, we say Michezo Sporting, we call it the Sporting Club, we say taxable income for 2015. Michezo Sporting Club, taxable income for 2015. So we say, we know that members' contribution will be subjected to tax. Members' contribution, we have gross members contribution. So the gross members contribution, we have it here. Part of it was what you call the entrance. We had the entrance. We had what you call entrance fee. We had what you call the entrance fee. So the entrance fee was a figure of 4,770,000. Then we had subscription, what you call the subscription fee. We had what you call the subscription fee, member subscription. Members, you just say member subscription as it is in the question. Members subscription. That is 15,900,000. Then we have penalties, what you call interest on late subscription. Interest on late subscription. Interest on late subscription. That should be 795. 795, the figure is 795. If you had this, if we add that, we should be getting a figure of 21,465,000. Then you say less allowable. Say less allowable expenses. Less what you call allowable expenses. Well, less the allowable expenses in this particular question. So additional information too, we are being told that operating expenses was 6,360,000, and interest and dividends was stated gross. So operating expenses, we have operating less operating expenses. So operating expenses for this particular question, that is 6,360,000 net taxable operating. So that net taxable operating income. We had the net taxable operating income. So if you have 21,465,000, then minus 6,360,000. So that should be about 15,105,000. Then you add what you call other taxable investment income. Add other taxable investment income. So we add other taxable investment income. So other taxable investment income, we have interest income. So we have on this at the end, we just proceed to this. So we have the interest. Remember, it's gross. If it was net, we need to get it as gross. So we've been told that these figures are stated as gross. For the interest and dividend, they are gross. So if you have an examination, particularly touching on this area, and you told that interest income was net. As you add it for the further taxation, you need to add it at gross. So the figure for the interest income, that should be a figure of 2,544,000. 2,544,000. Then you have the dividend income. So for the dividend income in that particular question, we have the dividend income to be a figure of 1,272,000. 1,272,000. But apart from that, there are other taxable investment income. That is the royalties and rental income. That is essentially the royalty and rental income. So royalty, we have the royalty. Royalty is 1,908,000. Then we have what you call rental. What you have as rental income. So the rental income is 6,360,000. So at that point we have what you call total taxable income. Total taxable income. We have what you call the total taxable income. So we had plus 2,544,000 plus 1,272,000 plus 1,908,000 plus 6,360,000. So then we have a figure of 27,189,000. A figure of 27,189,000. That is a total taxable income. So that is the total taxable income. We'll look at the figure. So then we get to the tax that is supposed to be paid, tax payable. So tax payable, we know that this members club are taxed at a corporate rate of 30%. So we have 30% times the 27,189,000. So what is the 30%? That should be times 0.3. Times 0.3, I have 8,156,700. 156,700. So then we less withholding. So we have what you call withholding on interest income. Withholding on interest income. Remember it was gross, so that withholding is 15% times 2, 544,000. So the withholding that we need to less, that should be 0.15 times 2,550,000. So that should be 381. 381. Then we have for the dividend income. That should also be 15% times 1,272,000. So that should be 0.15 times 1,272,000. So we have that as 190,800. Remember royalty. Royalty for residency, we know that the rate is 5%. So withholding on royalty. So for the withholding on the royalty, that should be 5% times 10. And there's no withholding on the rental. So 0.05 times 1908. So we have on this 95,400. So then we have what we call the net, net taxable, net tax payable, the net tax payable. We have what we call the net tax payable. if any, the net tax payable. So we less those withholding. We less the withholding. So we have 8,156,000. We just repeat it again, 0.3 times 27,189. Then we less 381,600 minus 190, 800. Then minus 95, 400. So that should be 7,488,900. So if you are to advise them, we are to advise the Michezo Sporting Club. Number one, as we just emphasize on what we have done, it is taxable. Why? For the investment income, regardless of whether the gross members' contribution is above 75%, those should be taxed at corporate rate of 30%. However, for Michezo, because the members' contribution does not exceed 75 and above, Michezo should be subjected to tax. And this is how we subject it to tax. And eventually, the tax that needs to be paid is 7,488,900. Just to emphasize on interest income, the interest income that is subjected to tax, they're called non-qualifying interest. The 15% withholding tax is not final. So therefore, you subject them to further taxation. So these were basically deducted before this money got to Michezo. Even the same to non-qualifying dividends, 15%. Even the royalty, the 5%. So these taxes were deducted at source. So you less them to get what you call the net tax payable. So this is the figure of tax that Michezo Sporting Club needs to pay. That is the figure that Michezo Sporting Clubs need to pay. So that is how we essentially tackle that question on taxation of trade association, amateur, and clubs. But specifically, most of the question will lie on club, based on explanation on trade association and amateur sporting. So that marks the end of the first illustration. We will pick on the next illustration. Welcome to Manifested e-learning platform. Today we are talking about taxation of extractive industry. And so we say taxation of petroleum, taxation, on that we say taxation. We say taxation of petroleum, taxation of petroleum and petroleum companies, taxation of petroleum companies, taxation. Remember, petroleum industries are basically extractive, and companies service subcontractors, and companies service subcontractors. Remember, petroleum industry is an extractive industry. So taxation of the petroleum companies and companies service subcontractors. So we start with the terms used. We start with what we call terms used. Terms basically used under the petroleum, in petroleum operations. Terms used in petroleum operations. Terms that are basically used in petroleum operation. So the terms that we basically use under petroleum operation. So we have the first term, that is what we call petroleum agreements. The first term is what we call petroleum agreements. The first term is what we call petroleum agreements. And when you talk about petroleum agreements, these are basically contracts, agreement between government and petroleum company, agreements between petroleum company, contracts of agreements. These are contracts. Contract is the same as agreement. Those are basically agreements. Contracts of agreements between, we say between government and petroleum companies agreements between government and petroleum companies to carry out, we say that to carry out petroleum activities, There should be this contract. When you talk about exploration, especially the ones that are done in a particular country, there has to be agreements between these petroleum companies and the government to carry out exploration or the petroleum activities. So the next time we talk about contractor, the next term is what we call a contractor. We call a contractor. Who is a contractor when you talk about a contractor? This is usually a petroleum company which has concluded petroleum agreement. A contractor is basically a petroleum company, is a petroleum company, basically a petroleum company which basically has concluded an agreement with the government, which has concluded, an agreement, which definitely has concluded an agreement with the government. A petroleum company which has concluded an agreement with the government. So we say contractor, in this case, is the petroleum company that basically was having an engagement with the government but has concluded, meaning that it can start the operation. So that is a contractor. The next term under exploration, we have what we call petroleum operations. Petroleum operations. Operations are basically activities that are basically carried by a petroleum company. And what are these activities? We have exploration, extraction, storage, and selling of petroleum product. So say these are activities. These are activities relating, we say activities relating to exploration, extraction, storage, and selling of petroleum product, and selling of petroleum product, and selling of what we call the petroleum products, and selling of the petroleum product, and basically selling of the petroleum product. That is what we call the petroleum operation. Activities that a petroleum company engages in, and we have talked about exploration, extraction, storage, and selling of petroleum product, because that is the major source of revenue for these petroleum companies. Then you go to what we call petroleum products. Petroleum products. We have what we call petroleum product. Petroleum products. These are products that basically emanate from this petroleum activity. We have mineral oil, crude oil, natural gas, carbon. Those are the products. See, these are means mineral. This means mineral oil. We have the crude oil. We have the crude oil. Natural gas. Carbon. Natural gas, carbon. produced from carbon produced from tar, carbon produced from tar. So these are the product, petroleum product, what basically originate from these petroleum extraction activities. So then we go to petroleum company, subservice contractors. Petroleum company, sub-service contractors. Petroleum company, sub-service contractor, very important term. Remember, the reason why we talk about these terms is as we get to particular questions or as we delve into this topic, these are terms that we will be able to come across. When you talk about the product selling of those are, we need to get to understand them, because some of the sources of revenue when you talk about petroleum product is what we sell. If we sell them, that is a source of revenue. We talk about petroleum company, service subcontractors, we say service, we call it service subcontractors. So when you talk about the service subcontractors, when you talk about service subcontractors, we basically means the purpose, for tax purpose, service subcontractors you sublet. So we're basically saying that for tax purpose, they're considered as a non-resident. For tax purpose, we need to understand for tax purpose, in relation to taxation, they are considered a non-resident. They're basically considered a non-resident. And the implication of considering the subcontractors as a non-resident, it basically implies that we need to tax them at the rate of 37.5%. We need to tax them at a rate of 37.5%. At the rate of 37.5%. But you also need to understand that company contracted by, they are contracted by. So service subcontractors, they are contracted, or they are called upon by these petroleum companies to carry out specialized activities. Contracted by petroleum companies, petroleum companies, we say that they're contracted by petroleum company to carry out, we say that to carry out specialized operation, to carry out what you call specialized operation. These are some of the operations that, the petroleum companies are not able to carry out. But very important, I have said on these service subcontractors that in relation to taxation, mark the word, they're considered non-resident. And you say, when you say non-resident, then we need to tax them at a corporate rate of 37%. 37%, we need to tax them at the rate of 37%. So then we go to what we call production. The next term is what we call production. We call it production. So when you talk about production, it's basically coming out, to give rise to something. So we basically say that quantity of petroleum produced, quantity of petroleum, we say quantity of the petroleum produced, quantity of the petroleum produced, and saved, and you say excluding what you call excluding petroleum used in operation, excluding petroleum used in the operation of petroleum companies. Excluding the one that is used in the operations of the petroleum company. Then we go to what we call production expenditure. Production expenditure. So when we talk about production, you know, those are quantity of petroleum that are produced. So expenditure, those are basically costs that we incur in the production of those products. So we say that our capital, these are day-to-day expenses. These are day-to-day. These are day-to-day expenses of a petroleum company. Why do you say is a day-to-day expenses? Because the major activities of this is extraction. And so basically what happens is that this when you talk about production expenditure, this will be emanate to a day-to-day expenses, but they relate to extraction. Then you can talk about what you call qualifying expenditure. What you call qualifying expenditure. We have what you call qualifying expenditure. Very important to understand that qualifying expenditure, these are basically capital expenditure. We can talk about capital expenditure in kind operation, capital expenditure. We say incurred in the operation of a petroleum company. Capital expenditure incurred in the operation of a petroleum company, incurred by a petroleum company. Capital expenditure that in a petroleum company, other than intangible, other than the intangible drilling cost, other than intangible drilling cost. But the word capital expenditure means basically expenditure that we incur, expenditure on fixed asset, So some are, they include the following. They include one, we know that plant, we have what we call plant, machinery, comma, what we have as furniture and fittings. We have furnitures and fittings. Number two, we can talk about what we call pipelines, storage tanks, pipelines, what you have as pipelines, comma, storage tanks. The second, and we can have our third one, qualifying expenditure, the capital expenditure. We have what you call industrial buildings in Kenya. Industrial buildings in Kenya. What you call industrial buildings in Kenya. We'll move to the next term. And we need to understand that for the capital expenditure, we claim investment allowance. We know that under extraction or mining investment allowance, we know that is 50% in the first year, 25% on a straight line from the second year on the remaining balance. So the next term, we call it a well. So a well is opening of ground through which oil is extracted. Opening from the ground, through which oil is extracted. through which oil is extracted. An opening from the ground through which oil is extracted. That is what we call a well. Then we can move to the 10th one. So we proceed on the last term, that is what we call intangible. Intangible drilling, we call it the intangible drilling cost. We call it the intangible drilling cost. So when you talk about the intangible drilling cost, we know it refers to expenditure, refers to the expenditure. We say refers to the expenditure, refers to the expenditure, refers basically to the expenditure, refers to the expenditure which have no salvage value. So, and when you talk about salvage value we know is what we call a residual value, the value that we have at the end of the operation, which have no salvage value, which are, we know, which are incidental to drilling. We say that which are basically incidental to drilling, which are incidental to drilling. Cleaning, comma. We have deepening, completing, and what we call abandoning of the well, and what we call abandoning of the well, and what we call abandoning of the well. So we say that they include intangible drilling cost. We know that they include what we call cost of determining well location, cost of determining the well location, you know, where to dig the whole location, well location, cost of determining what we call the well location, cost of determining the location of the well. We can also talk about geological, cost, geological costs. We have what we call geological cost. We had the geological. These are now the intangible drilling cost. So then I want us to proceed to determination. Determination. We start on the determination of the taxable income for this extraction. Determination of the taxable income. How do we determine the taxable income? Determination of the taxable income. How do we basically determine the taxable income for this extraction? So we know that taxable income is determined using, we say that the taxable income is basically determined using basically two methods. That is what we call the net profit method. The net profit method we apply when we have been given the accounting profit. And therefore, using the net profit method, we need to adjust the accounting profit to get the taxable income for the extractive company. Then we have the second method, which we call the gross profit method. For the gross profit method, we are not given the accounting profit. And so we get the taxable income, then we less what we call the allowable expense. So we're saying that the two methods are basically net profit method, and two, we have what we call the gross profit method. Again, we know that for the gross profit method, accounting profit is not for the gross profit method, accounting profit is not provided. For the net profit method, we have to be given the accounting profit. After determining this, the taxable income, we say that petroleum companies are taxed at a corporate rate of 30%. So after determining the methods, after we determine the taxable profit, we need to understand that they are taxed at corporate rate of 30% for resident, and 37.5% for the non-resident, companies, and 37.5% for the non-resident company. So for the non-resident company, I've said that for the resident company, we tax them at 30%. For the non-resident, we tax at the rate of 37.5%. The following, basically, as we were saying, that for petroleum companies, which are extractive company, we tax resident company at a corporate rate of 30%, and 37.5% for the non-resident company. And then we need to understand that the following specifically applies. The following specifically apply to petroleum companies, petroleum companies. So the following specifically apply to petroleum company. Under this specialized, one of the most important things is the basic. Our concept on taxable income and non-taxable income, that is basically a concept that was basically touched on the intermediate. We need to understand the taxable incomes, like for example, the taxable income for general business. We know that for a realized foreign exchange gain, trade debts that were written off, that were previously written off and recovered, that's taxable income. We also need to understand that reduction in specific bad debt is also a taxable income. We also need to understand that compensation from insurance company for the loss of stocks is also a taxable income. So when you get to this specialized, and now the following specifically apply to petroleum company, we have what we call additional taxable income. We have what we call additional taxable income. We call it the additional taxable income. Apart from those that I've mentioned, now these don't specifically apply to petroleum company. One is what you call amount received from the sale. Now, what are we engaged in? If you're a petroleum company, we are basically engaged in selling products that emanate from extraction of petroleum. So sale of petroleum products, one of it, sell, additional taxable income, sale of the petroleum, when we say sale of the petroleum products, sale of the petroleum products, what we call the sale of the petroleum products at arm's length. We say at arm's length, the second we have as a source, because those are specifically for the petroleum. Income of what you call disposal, interest, income of disposal interest in petroleum activity, in what you call petroleum activities, income of disposal interest in petroleum activities at arm's length, at what you call at arm's length. at arm's length. Then we have sales at arm's length. Sales is at sales is basically sales is at arm's length. Arm's length. On meeting, we say on meeting the following, we say on meeting the following conditions. The sales basically is at arm's length on meeting the following conditions. For sales basically to be at arm's length, one of the conditions is that money is the only consideration in the sales agreement. At arm's length is that money is only the consideration in the sales agreement. That for sales to be at arm's length, money is the only condition. Money is the only condition. Money, we say money is the only consideration. Money is what you call the only consideration. Money is only the consideration. Money is only the consideration. We say that money is only the consideration in the sales agreement. In the sales agreement. In the sales agreement. But very important, you need to understand now for these major items that you're going to add have as taxable income relate to the sale of petroleum products and incomes of disposal interest in petroleum activities at arm's length. And I was saying that the first, when you talk about arm's length, for sales to be at arm's length, one of the conditions that money is the only consideration in the sales agreement. The second, we can talk about terms of sales. We say that the terms of sales, the terms of sales, what they call the terms of sales, the terms of sales are not determined, are basically not determined, are not determined by any other factor, are not determined by any other factor, are not determined by any other factor other than commercial, any other factors other than what you call the commercial, other than the commercial relationship, other than the commercial relationship between, other than the commercial relationship between the seller and the buyer. The seller is the petroleum, other than between the seller and the buyer. Other than the commercial relationship that exists between the seller and the buyer. And the seller in this case is the petroleum company, that is at arm's length. Then lastly, we just say seller does not have, seller does not have any interest, does not have any interest. The seller basically does not have any interest in the subsequent, we call it in the subsequent, what you call the subsequent resell. You know, what happens after that, whether you want to sell it again in the subsequent resell of the petroleum product, of the petroleum resell of what? Of the petroleum product. It does not have an interest of the petroleum product, on the petroleum product, on the petroleum product. So that is on taxable income. The first point was basically on taxable income. We have mentioned two very crucial things, that when you're engaging in petroleum product, realize that what are you doing? What you're going to do as a contractor is to sell the petroleum product. We have income of disposal interest in petroleum activities at arm's length. And we've talked about what we basically mean sales at arm's length. One key thing that we notice is that money is the only consideration in sales agreement. The terms of are not determined by other factors other than the relationship between the seller and the buyer. Seller does not have any interest in what you call subsequent resell. You know, whether you buy and you decide to resell those products, it does not have what you call interest on that. So I want us to move again to the next item, additional allowable expense. This should be additional allowable expense. Additional allowable expenses. What you call additional allowable expenses. So when you talk about allowable expenses, basically in taxation, these are expenses that we know can be deducted against a taxable income. These are expenses that can be deducted against a taxable income. Very precisely, we talk about on the general taxation of a limited company. We talk about some of these expenses as increase in specific provision for bad debt. We also talk about unrealized foreign exchange loss as additional allowable expense. We also have some of the legal costs when you talk about renewal of a lease that is less than 99 as allowable. But now when you talk about specialized, for example, when you talk about now mining, the specific that needs to be added to such, the specific that needs to be added as additional, the ones that are specifically needed to be added apart from the ones that are generally applies to the companies, like I've mentioned, increase in specific provision for bad debt. I have also talked about realized foreign exchange loss. So for the petroleum, some of them we say they include. We say they include. We can have one, what you call intangible, all intangible drilling cost, all intangible, what you call all intangible drilling costs. So when you see this as part of expense, geological and geospatial, geological, e.g., we call it geological costs. So when you see such an expense on items, for example, on items, when you're given an information to get the taxable income of an extractive or petroleum industry, if you see intangible drilling costs, those are basically allowable expense. Amount paid. We say amount paid to the government in relation to the agreement. Amount paid to the government in relation to the petroleum agreement, in relation to the petroleum agreements. Amount paid to the government in relation to the petroleum agreements. One thing that you need to understand, particularly on those amounts, we need to understand that one of the things that is not included, we need to understand that tax excluded. Under this, tax should be excluded. Tax is not part of that. If tax was paid, tax basically should be excluded, or tax not included. Excluded means tax not included. So then we have what we call another additional administration cost. We have what we call administration costs. Administration cost, to manage administration cost, management fee, and what we call professional fees paid in Kenya, and the professional fees that are basically paid in Kenya. Those are additional allowable expense. Allowable, we say that you can deduct them against taxable income. And this, note this carefully. Point 2, amount paid to government in relation to petroleum agreement, tax excluded. So the tax that is paid is not allowed. Amount paid to petroleum company, amount paid to petroleum company, sub-service contractors. You know, sub-service contractors are basically involved for specialized work. Then we can also talk about production expenditures, what we call production expenditure. And you say that production expenditure day-to-day running costs that are basically for running. Then we talk about interest on loan. Interest on loan. We have interest on loan, borrowed, and we say invested into the petroleum company. Interest on loan borrowed and invested into the petroleum company, petroleum companies' activities in Kenya. Activities in Kenya. So we can put another one. These are basically capital expenditure. We talk about capital expenditure. Petroleum investment allowance, what they call petroleum investment allowance. Those are fixed assets that relate capital expenditure. Granted, we need to understand, granted on what we call capital expenditure. Granted specifically on capital expenditure, such as we have the plant, we have specialized mining, specialized mining machines, specialized mining and drilling machines, and drilling specialized mining and drilling machines. We have pipelines, and then we can talk about tanks and industrial buildings. Tanks and what we call industrial buildings. Tanks and industrial buildings. So this is just based on investment allowance. And we need to understand those investment allowance. We know that there is investment allowance at the rate of 50% in the first year, 25% per annum on a straight line. From the second year on the remaining balance. Those basically involve manufacturing, items in mining, like the extractions that we have. We also have farming, but we say that those will be granted petroleum investment allowance, that we need to understand the investment allowance. To be very specific, that we know that these ones should be basically at 50%. Under mining, if you look at the tax table, that should be basically 50% in the first year, and we say 25% per annum on a straight line from the second year on the remaining balance. So investment allowance under petroleum industry, we talked about, we grant it on capital expenditure. Under petroleum, that is mining and drilling machines, pipeline, tanks, and industrial buildings. So we need to understand that we grant it under mining. Investment allowance is granted. We say granted at the rate of what we call 50% in the first year, in the first year, 50% in the first year, 25% per annum on a straight line, 25% per annum on a straight line, on a straight line, on a straight line, from the second year, from the second year, on the remaining balance, on the remaining, what you call the remaining balance, on the remaining balance, from the second year on the remaining balance. Implying that after getting the 50%, now the 50%, we get it 25, implying that 4 years. For this investment allowance, they should take about 5 years. The first year, 50%, then the others should be taking 25% of each of those 50% that is remaining. That should be about 4 years. Then we have another normal, we call it 7. Normal investment allowance. Remember, this investment allowance is basically applying to mining machine. In normal investment allowance for fixed asset, for fixed assets, normal investment allowance for the fixed assets, for other investment, for other investment. For example, when you have items like motor vehicle, we all know that they should be under investment allowance at the rate of 25% on a straight line. We know that if you have items like furniture and fittings, they should be under investment allowance at the rate of 10%. So those are other investment allowance at 25% and 10%. Those can be granted, such as other investment we say normal investment allowance for fixed asset. For example, we say, for example, motor vehicle, which I said, furniture. We have the furniture and fittings, etc. So other investment, furniture and fittings, those should fall there. Then we have cost of well abandoned, cost on well abandoned. So cost, remember this cost on well abandoned, on failure to discover, we call it to discover oil. So cost on a well that is abandoned, when you fail to discover oil, that should also be allowable expense. And that needs to be noted. That oil, when you talk about a well, these are holes that from underground that we use for extraction of oil. So we're basically saying that for those wells that are abandoned as a result of failure, to discover oil, those will also be allowable expense. We have what we call commissioning and mobilization cost. Commissioning, what do you have as commissioning? What you call commissioning, and what you call the mobilization cost. Commissioning and what you call the mobilization cost. Cost. So what are commissioning and mobilization cost altogether? Because sometimes you ask what is commissioning and mobilization cost. We know that our cost incurred are the cost incurred to take, are when you talk about commissioning, are the costs that are incurred to take away resources from the mining, we call it, from the mining, to take away resources from the mining site, we say in case of what you call failure, in case of failure to discover oil, in case of failure to discover oil, in case of failure to discover oil. Then we can have a last one, in case of failure to discover oil. We can talk about lifting and extraction cost, what you call lifting and what you call extraction. We call it the liftings and extraction cost. Lifting cost, these are basically involved undermining what you call the lifting cost, lifting and extraction cost. We know cost to bring oil to the surface. Cost to bring, when you talk about extraction and lifting, cost to bring oil to the surface. We say to bring oil to the surface, from underground to the surface. Cost to bring the oil to the surface. And then we talk about, we can also talk about memorandum of understanding, credit granted by government. Memorandum of understanding, credit granted by the government. So we can move to what we call taxation of petroleum service subcontractors. Taxation, we move now to taxation of what we call the petroleum service subcontractors. That is the PSS. PSS subcontractors. Remember, we say that when you talk about the subcontractors, when we say the subcontractors, these are basically hired. They're hired to carry out specialized activities under extraction. And we did say under the terminologies that we basically treat them as non-resident. We basically treat them as non-resident. And by the virtue of treating them as non-resident, we basically know that we need to tax the non-resident at a corporate rate of 37.5%. So we need to say considered to be non-resident. The first thing you need to know, considered. We say considered to be what we call non-resident. Considered basically to be non-resident. Considered to be non-resident. And by the virtue of considering them to be non-resident, we need to understand that we tax them at 37.5%. So considered to be non-resident company, and therefore, we need to understand, and therefore, we say taxed at a corporate rate of what we call 37.5%. And therefore, we tax at corporate rate of 37.5%. Taxable income, we need to understand that the taxable income of, we need to understand that the taxable income of petroleum service, petroleum, the taxable income of a petroleum sub-service company, very important company, is of a service company is usually taken as what we call 15% off, is usually basically taken as 15% of the amount of the amount received received from the petroleum. For this service company, service subcontractors, we say that the taxable income is taken, taxable income of petroleum service company, 15% of the amount received from the petroleum company. 15% of the amount received from petroleum company, excluding the, we say that excluding the amount received, the amount received as what we call reimbursement. Maybe they used reimburse, amount received as reimbursement, amount received as reimbursement, reimbursement, amount basically received as reimbursement for work done, for work done by PSS. And PSS, we know that petroleum service subcontractors, petroleum service subcontractors. So amount that is reimbursed for services that they use their own money, that is excluded from the 15%, excluded from the 15%. On behalf, done by the PSS, on behalf of the petroleum company, on behalf of the petroleum company, on behalf of the petroleum company, on behalf of the petroleum company. So we say that PSS payment of expenses on behalf, that is PSS, petroleum service subcontract, PSS payment of expenses, payment of the expenses on behalf, we say on behalf of the petroleum company, on behalf of what we call the petroleum company. So when that is done and they reimbursed, that is not part of the 15% of the amount received by the petroleum company. That is what we say. That is not part of the 15%. So then we need to understand that the tax rate of 37, the tax rate, very important, the tax rate of 37.5%, of 37.5%, the tax rate of 37.5% is usually what you call a withholding, is usually a withholding, is usually a withholding, is usually a withholding tax by the petroleum company. So that tax rate of that 7.5% is usually withholding tax by the petroleum company, which should be remitted, we say remitted. It should basically be remitted to the Kenya Revenue, to KRA, by, it's usually a withholding which should be remitted to the Kenya Revenue Authority by 20th of the following month. By 20th of the following month, we'll say by the 20th of the following month, after the month that you withhold it, after the month of withholding, after the month of what you call withholding, after the month of withholding. So that should be remitted after the month of withholding, after the month of withholding. That should be remitted to KRA in the 20th of the following month, after the month of withholding. That marks a discussion on the basics under taxation of extraction company, and to be precise, petroleum. We pick on examples. illustrations particularly pertaining to that. That is where we move to on the
How do we create an agency? And it may come into existence by any of these ways. That is by agreement. And we get an agency by agreement where we both mutually agree to create it. And we must have capacity. That is, we must be of we must have a meeting of minds. And we must be sane, and we must be able to enter into that contract. We cannot have an agency where either of us are prohibited by law to enter into it. You see, you cannot have an agreement if there is no meeting of minds. So what we are saying, where we are creating an agency by agreement, there is a meeting of minds that we have agreed. These are the terms and conditions. This is the extent to which I am giving you this house to look after. And as a general rule, there are no formalities, but an agent must be appointed for the purpose of signing documents in the principal absence. This is where I want to leave the country, but I want you to sell my land and transfer the money to me when I am away. So I will sign over a power of attorney in which I allow you to act on my behalf in the legal sense. This is where we agree to what extent, and it is written down. So a contract of agency may be express or implied from the conduct of the parties. And a third party is allowed to rely on that assumption. We also have an agency by ratification. And what do you mean by ratification? This is the adoption or confirmation by a party of a contract previously entered into by another purporting to do so on his behalf. Where we have said an agency can be implied, if it's implied and we adopt or confirm, then we are ratifying that agency. And agency by ratification arises after the agent has acted, and it comes into existence when the person on whose behalf the agent purported to act and without whose authority he acted adopts the transaction as if there had been prior authorization. By ratifying the transaction, the agent's authority is backdated to the date of the transaction. And this is where we are saying, if someone comes and does something without your express authority, but later you come and affirm that, yes, he is allowed to come and switch on these lights, those security lights, and come 6 a.m. comes and switches them off. He may not have acted with the authority, but the minute you allow him to continue doing that, you accept it as an agency from the date he first acted. But for ratification to arise, again, we're insisting this agent must have purported to act for a principal, and the principal must be competent. That is, you need to have a natural or juristic person. You can't act for a principal, again, with no capacity. The agent must as well have capacity for there to be ratification. But this agency must not be illegal. You cannot ratify an illegal contract. And the principal must have been aware of the material facts affecting the transaction. And again, you cannot ratify only part of it. You ratify it in its entirety. You accept that you have given someone the authority, the power to act on your behalf. And in so doing, both of you have the capacity, there's no illegality, and you knew and continued to accept. And once you do, the first instance the person did that, it's good to go. We also have agency by estoppel, and this is from the equitable doctrine of estoppel, where a party by word or conduct represents the other third parties as his agent, and the third parties deal with the agent. So the other party is stopped from denying their parent agency. And this arises when none of the parties have any relationship, but one of them represents the other as an agent, and the third party relies upon that representation. So someone must have relied upon it and believed that these two have transferred that authority and the powers. We also talk about the agency relationship may be existing, but the principal represents the agent as having more authority. This is where you allow them to go way over and above what they thought they did. And what are the conditions for agency by estoppel? 1, there must be a representation by word or conduct. 2, there is reliance upon the representation by the representee. And 3, there is a change in legal position as a result of the reliance. And lastly, it would be unfair not to stop the representer. So we have Freeman versus Brackenhurst Park, where the articles of association of a defendant company created the position of a managing director, but at the material time, none had been appointed. But one director, with the knowledge of the others, purported to act as the MD. He engaged the plaintiff firm to work for the company, but the company refused to pay once the services had been rendered. The company argued that it was not liable as the director was not its MD and therefore had no authority to contract on its behalf. It was held that the company was liable as it had represented this director as the MD and third parties had relied upon this representation. So they were stopped from denying his apparent authority. We also talk about agency by necessity. And this is an agency created by law. And it's either commercial or domestic. So a commercial agency will arise where one is in possession of another's goods and an emergency arises that requires immediate action in relation to the goods. And it's impossible for the party to seek instructions. But for this agency by necessity, that is commercial agency of necessity, 1, there must be a genuine emergency necessitating action in relation to the goods. And 2, it's impossible for the party in possession to seek instructions from the owner. And 3, the party in possession must act in good faith and for the benefit of the other party. Case in point, the recent, when we had the protests, if your neighboring shop, the owner sees that your goods may be destroyed and takes them and keeps them for you, and in keeping them for you, they incur charges, storage costs. They've acted out of necessity and there was that emergency. Probably you left your shop closed, you went home, you are safe at home, but then goons came, broke open the door, but your neighbor was able to recover the goods and take them off and keep them safely for you. So when you come in the morning, they tell you, no, your shop was broken into, but your goods have been kept safely in a storage space. I contracted the owner of the storage space to keep the goods safely for you for maybe 30 days. Essentially, your next door neighbor becomes your agent. One, they have acted in good faith. Two, they have prevented your goods from being destroyed. And three, it was an emergency. It was not the normal or ordinary course of business. So in that aspect, it becomes a commercial agency out of necessity. We also have a domestic agency of necessity. And this is in common law, where a deserted wife is regarded as an agent of necessity with authority to pledge her husband's credit for necessities. So again, she must have been deserted. She must be free from blame, and you only get necessaries: food, shelter, that. And again, what are necessities will be determined by law, case-by-case basis. We also have an agency by presumption or cohabitation, and it is presumed by law. And this is where a woman and a man are living together that portray them as such. So there's the domestic establishment, there's cohabitation, and there's necessities. And this is where the woman goes and, let's say, gets food from the neighboring shop. And the man comes to pay. We have seen them happen in our various dwelling places. So the shopkeeper will tell the man, you have an outstanding debt of ABCD. Essentially, the woman is an agent out of this presumption of cohabitation. But this agency will not arise if the woman goes on her own behalf and contracts personally, and this man has expressly or implicitly instructed the woman not to pledge his credit. Again, necessities, there is no separation. And this type of agency, it's at the discretion of the court. You remember, it has been presumed by law. It is not something where we are able to sit down and agree to what extent it can apply, to what extent it can't apply, and to whom. And some of these things can only be determined by a court of law. Who was this woman acting on behalf of, and what do necessities constitute? We will leave that at that, because we may not have, there are no known boundaries. You see, we have talked about estoppel, we have talked about ratification, and by agreement. And for those, we are able to identify the boundaries in which this agency arises and can be withheld.
All right. So for today's session, our main focus was meant to be this. PV is short for present value. It's a relatively straightforward concept. So the idea is you're trying to get the current value of some future stream of income. The idea is there's something called the time value of money. Okay, the time value of money means like a shilling today, if you invest it, might be worth more in the future. Okay, if you invest it. If you don't invest it, it might be worth less in the future. So the value of money changes with time. So that is what we're calling the time value of money. So we're saying the present value is a current value of an expected future stream of cash flow. It is based on the concept of the time value of money. So the present value is based on the concept that a particular sum of money today is likely to be worth more than the same sum in future, because it can be invested and earn a return in the meantime. So the context here is the money is being invested somewhere and it is earning some interest. It is not just sitting somewhere. And of course, if it just sits somewhere, it will lose value due to different factors, inflation and so forth. Then this present value calculation requires an estimate of a potential rate of return, which is called the discount rate. This is the rate, the approximate rate at which it will increase in value. Okay, so sometimes, because we are talking about the future, sometimes this can be estimated. Yeah, it needs to be estimated if it is not when you have not been given a fixed rate. Okay, so you can also calculate what is called the future value. Okay, I think I'm mixing those concepts. With present value, you have some cash in the future. You're investing some money somewhere. You want to get, let's say, $200,000 in future. What is the current value of that 200,000? Okay, so it's a bit of the opposite of what I'd said before. Apologies for that. It is you're looking at a future sum. You're trying to think what is the current value of that money. If it will be 200,000 in 10 years from now, what value is it now, given some discount rate, given some percentage rate at which it increased in value? Okay, while future value, which is what I have here, the future value is you have some sum today, how much will it be in the future? So the future value is relatively straightforward to understand, because it's more like what you do when you invest some money and you are getting some, say, for example, some interest every year, whether it is compound or simple interest. Of course, the future value will be greater than the present value. Okay, so if you think about the two concepts, they are opposites of each other. Future value, you are here now, you have some money. Let's say you have 1,000,000 shillings. What will it be 10 years from now at, say, 8% per annum? What will it be? So the future value function allows you to calculate what the value will be in future. The present value function, you take some future sum of money and then try to work out what is its value today, or what must I invest today to arrive at that goal in the future. Let's say I want 3 million in my account at 10 years from now. How much do I need to put in today? Let's say at 6% interest rate. How much do I need to put today to reach that goal? That is present value. Okay, let's jump into an example. So how do we work out future value? We will use, there's an FV function, future value function, but there's a manual way of working it out. If you remember, I don't know if you have done the compound interest formula. You can use a manual way of doing it, but because we are trying to use Excel, we can use the FV function, this one that I've already used here. Let me zoom in a bit so that you can see it. So I have 100,000. I'm investing it for 20 years at the rate of 6% per annum. This is the annual interest rate. Okay, so what will the value of that money be? What I've done here is I've gone 1 year, 2 years, and 3 years, and so forth until 20 years from now. So we want to see how does it change every year. Okay. So for the first year, how do we use these numbers in the FV function? So let me just retype it here so that we can see it. So I have equals FV. Okay. And what are the parameters? If you're doing this in Excel, the nice thing with Excel is it will show you the parameters here. So that in the program I'm using today, Google Sheets, it's not showing me the parameters. But if you look at this, E18 is the interest rate. So the thing that will come first is the rate. okay, E18. Then if you look at G15, it is the amount that you are investing, right? Then this one is it would be the PMT. Remember we talked about PMT earlier on, like what would be the monthly or annual amount that you invest. But in this case, because we are not investing every year, we are only doing one lump sum amount to start with, then that is what we will be waiting for the next 20 years. So we'll assign that value as 0. Okay, if you have an access to a computer somewhere with Excel, please look at this, confirm that that is PMT. Then the last one is the amount that you are investing. So this would be, if you look at Excel, this would be called PV, present value. This is the amount that you're investing now. And you would normally use a negative, like you would make it minus something because it is money going out. Okay, otherwise, if you don't put that minus, you will get a negative answer. Okay, but ideally, because it is money that you are investing, it is, from your perspective, it is money that is going out. That is why we put a negative there, and it gives you a positive answer. So if I invest 100,000 today at 6%, in 1 year, it would be worth 106. In 2 years, it would be worth 112, and so forth. So the idea here is, if you're using Excel, the nice thing when you're using functions is there will be this wizard here guiding you. So you will just need to follow those steps and you will have your answer very quickly. That's why I said these functions are pretty straightforward. So that's future value. You're given some money today. What will it be worth a few years from now? So the question here I was answering was this one. What is the future value of 100,000 shillings 20 years from now, given an annual interest rate of 6%? Okay, that is a straightforward formula. Then let's try and talk about present value. What is the present value of 200,000 10 years from now? Like 200,000, this is the value of the money 10 years from now. So like we are now in what, 2024, 2034. If I have 200,000 in 2034, what is it worth today in today's money? That is what this question is talking about. Okay. Or 3 million 10 years from now, what is it worth in today's money? So the formula is very similar. So again, we have the amount that we need to work with. The years I'm working with is 10, and the rate is 8%. Okay, so this time round, I've kind of moved backwards. I've started with this is the value of the money in future. What is that worth today? If you use the calculation, the PV function, okay, notice again, we start with the rate, right? I'd like, again, like I've said, look this up in Excel. You start with the rate, then go to, so this should be the rate. Then G22 is where the present value should be. No, sorry, G22 is this. It is a period, the payment, that will be the NPER, the payment period. So remember, like when we were calculating IPMT, okay, there is a payment period. If we were talking about 12 months, each of those months was the payment period. Okay, so this is the 10th year. It is what goes here, like which year are you referring to? The G22. Then there will be a 0 value here, because this will be FV. If you look at the formula in Excel, you will see that this will be FV, then this is the future value. This will be the value we are looking at. Actually, the FV is this one, the one here. Okay. So I would like you for you to look it up in Excel. This one I assigned a 0, then I did this as this is a future value. Then again, because I want a positive answer, I'll make this a negative. Then if I press enter, what this 92,000 means is if I invest 92,000 today at 8% per annum, 10 years from now, it will be worth 200,000. Okay. 5 years from now, so I kind of worked it backwards. 5 years from now, so what is changing if you look at this formula compared to that one? I am changing the period. This one remains fixed, the interest rate, but the period is now 5 years. As I go along, you will notice it will keep changing to 4 years and so forth. So if I want to, if I want 200,000 1 year from now, this is what this 1 year means. If I want 200,000 1 year from now, how much do I need to invest at 8%? So I would need 185,000. So it's very close to the goal because the period here is shorter. I would need to invest a larger amount of money for me to reach that goal of 200,000. Right. So that is present value and future value. I will send you this worksheet as well so that you can read through the notes. Okay. And I think what I will do is also this worksheet, I did it in Excel. So what I've noticed is it works the same way in an example we'll do here. So net present value, let's say for year 1 and